Special seasonal items are always popping up and available upon request. To purchase, you can visit our online store at brooklyncafe.tv/shop. Happy shopping!
True oldies live here. 95.3 and 96.9.
This program is furnished by amp2tv.square.
The content, information, and opinions expressed during the related show are those of the show personalities and guest alone, and not those of Vic Canellis Media Group, its parent, affiliates, or stations. VCMG Live is not responsible for any content, information, or opinions expressed. User bears full responsibility for their reliance on such content, information, or opinions.
Sanders, a name you can trust. With over 20 years of real estate experience and selling over 150 homes a year, Laura Sanders is the #1 RE/MAX agent in the state of Florida for 2021. Join us each week as we discuss how to make money through buying and flipping homes, to renting versus selling, and everything in between. To join the conversation, call in live. 888-994-4995. Studio A.
Hi, and welcome to Making Money with Laura Sanders, a name you can trust. So we're here on a weekly basis at 6 o'clock on Monday evenings, and we're here to discuss all different ways that you can make money in the real estate industry. So today we have our guest with us, and we have Mason Pruner with the mortgage firm. And today we're going to talk about how we can help you make money or buy properties where you can make money in the real estate industry. Welcome, Mason. How are you?
I'm well, Laura. Thank you for having me on the show.
You're welcome. So there are a lot of programs out there that I think that our audience doesn't know about, and I would love to start to talk about some of those programs. One of the programs that I don't think a lot of lenders have is that 5% down, because there's a misconception that you have to put 20% down to buy a property to live in, is 5% jumbo. And maybe you want to tell them a little more about what jumbo means, what price point that starts at.
Sure,
and what
absolutely.
It can go up to.
And that is, as you said, a very common misconception. Jumbo mortgages, so there are conventional mortgages, there's FHA mortgages, and then there's conventional mortgages. Okay. Jumbo mortgages are anything over the conventional loan limit, which this, as for 2022, is $647,000. Now, early in October, lenders started releasing a higher conforming loan limit at $715,000, but essentially anything over the $647,000 is truly a jumbo. Now, in most cases, for most lenders, a jumbo, anything over that, you're going to need at least 10% down. We do have a program that goes up to $850,000 with 5% down, so that's a real nice opportunity for somebody that's looking, especially with home prices as they are here, as you know, in South Florida, to be able to get in with less money down.
So when you say up to 850, so if I wanted to buy $1 million home, I could do 5% or I couldn't?
So on a $1 million home, the 5% is capped out at $850,000 loan amount.
Okay, so they would have to still come up with.
They would still have to come up with a difference.
$150,000.
But we've got a very good 10% down, no MI program as well that goes all the way to $2 million loan amount.
Oh, well, that's amazing.
Yeah, it's a brand new product we just got. There's no mortgage insurance on the program.
So that's what MI means, because make sure we have to remember that some of our listeners don't really know all these little acronyms of MI or what that is. So
correct.
You know, we want to make sure that they're not saying at the end of the show, what the heck did they talk about?
Exactly. Yeah, mortgage insurance, when you're putting less than 20% down, it actually insures the lender against default on the loan.
Okay.
So that's what mortgage insurance is for.
So those are two great programs that I think that when buyers are thinking about buying, we want you to know that you can buy a primary residence with 10% down with no mortgage insurance up to $2 million, and you can buy a primary residence with 5% down up to $850,000.
Correct.
Now you can buy for more, but you'd have to come up with the difference of whatever that
Absolutely.
is from the 5%.
Correct.
Okay. So tell us a little more about people that don't report their income to the IRS.
So,
can we help them?
So a significant number of households are self-employed.
Okay.
And those that are self-employed know there's very strong advantages to being self-employed. There's a lot of deductions you can take, which helps on your income tax. The downside is when they go to apply for a mortgage, because as a lender, we're required to independently verify everything that a client tells us how much they have in assets, what they report in income. And for self-employed, the only way to report that or to independently verify that is through their tax returns. However, as we've just noted, one of the advantages of being self-employed is you don't necessarily report after deductions what you truly make. Now, there are programs that enable somebody that's in that situation, and we've closed many of these this year, where we'll take their bank statements instead, look at their deposits, and verify their income based on those deposits over the last 12 months. We can use either their business account deposits or their personal account deposits. And to give you an example, I had a client a couple of months ago, reported $16,000 net income in their tax return and qualified for a $750,000 purchase because they really run a lot of money through their accounts.
Okay, all right. If anybody does have questions from Mason and wants to get some answers, and we're not really answering them today, you can call us at 1-888-994-4995 in Studio A. So if you would like to call us, you could call us at 1-888-994-4995, and we are in Studio A. Okay, so going back to some more questions,
Sure.
which we have a lot of them, okay?
Good.
Another question would be, and I am a realtor, I am with RE/MAX, I have been for over 20 years, and I do a lot of transactions. One of the loans that I've been using recently with clients is, and I always get the letters wrong, DCS loan.
Yeah.
Okay,
Yeah.
so tell us about a DCS loan.
Okay, so it's a debt service coverage ratio, DSCR. And what that does, so this is a program where somebody can buy as an investment property, a property to be able to rent out without supplying any income documentation at all for themselves. All we're going to look at is how much the property is going to bring in rental income and use that to qualify the property. So we'll take the total monthly payment for the property, principal and interest on the loan, taxes, the insurance, and then figure out how much, through an appraisal, how much the property should rent for on an annual basis. You can't use Airbnb or other types of rental. You have to use an annual lease. And as long as you've got a 1% or better, another 100% coverage ratio, you can get the loan.
Now, isn't it true though, if the rents, because we know that a lot of people really do use these for Airbnb, so their numbers are going to look a little different than yours. So isn't it true though, if your numbers don't jive with that, they can put a little bit more down to make the numbers jive?
Yes, absolutely, because part of the calculation is the debt to income ratio is the principal and interest on the loan. Simply putting a little bit more down on the loan, on the purchase price, lowering the loan amount, gets that DSCR, that debt ratio, in line with the guidelines.
Okay. And when people are shopping for mortgage lenders, what should they look for?
That's a great question, and that's probably a question we hear a lot because there's a lot of different kinds of lenders out there. Of course, there's banks, and I used to work for a bank, and there's pluses and minuses to the banks. There are more on the other end of the spectrum. There's mortgage brokers, and what a mortgage broker does is they collect your information, they hand it to a bank, and then there's a correspondent lender or a direct lender, and that's what we are at the mortgage firm. And what we do is we process, underwrite, fund everything in our own name, which means we also have the ability to pick different kinds of investors to sell the loans to afterward. So when somebody's looking at trying to figure out what kind of a lender should I be doing and what should I be asking that lender, find out first of all, what their experience is. How long have they been doing this? What is their background? They need to really vet the company as well. There's a lot of small mom and pop mortgage companies out there that really don't have the track record. You want to deal with a reputable company. You want to make sure they have the products that you need and that their pricing is in line with expectations. Check their reviews. Zillow, Google, all these other firms. We use Social Survey, which is now experience.com, and we survey every one of our clients. And checking those surveys is critical. Look at how the process went. Look at how the final closing result was. Was there a misrepresentation of costs? Did everything go smoothly? Definitely taking the time to make sure that you're dealing with somebody that's going to take good care of you and by all means, ask your real estate agent for a recommendation, because your real estate agent knows these things, has probably vetted that lender to a high level to make sure that the service is there.
Okay. Now, is this fact or myth that when you shop around for mortgage lenders, that your credit score will go down when you're having each of these mortgage lenders pulling your credit?
You know, that's also a great question, because that is a common fear among people, and that is a misconception as well. Now, it did used to be that way. When they first came out with credit scoring, and believe it or not, I've been in business long enough to where I remember when credit scoring came out. Credit inquiries, because back when this first started, credit inquiries was a possible flag for pyramiding of debt. There were people out there that were talking about trying to buy homes with no money down by going out and getting a bunch of credit cards and advancing on them. So the history, they put that in the little black box that figures credit score as, well, all these inquiries, they must be pyramiding debt. Now, the backside of that is they realized that it was also prohibiting people from shopping, and that was not fair to the consumer. So they changed that that little algorithm in the model several years ago to where like kind pulls, in other words, mortgage company to mortgage company to mortgage company, or if you're out shopping for a car, different car companies pulling your credit within a short period of time does not negatively impact your score.
Okay.
So that way you are free to shop and make sure that you're getting a good price. You don't have to worry about your credit score going down.
Okay. Also, just want to remind you, if you do have questions for Mr. Pruner from the mortgage firm, you can call 1-888-994-4995, Studio A. If you do have questions, please call in. We definitely want to answer your questions. Okay, next question I have for you is still on credit, because
Okay.
I think credit's a really important thing. I think
Sure.
that we should instill in our children as early as, 12, 13 years old when they're getting bank accounts, about credit. And let's talk about balances that you should hold on your credit cards in order to not affect your credit to go down.
Okay, so there's, in the model, in the credit scoring model, there's several categories. Obviously, delinquencies are a big hit to credit score. But also what you're talking about is called credit utilization. And credit utilization is how much of your available revolving credit, it's only on revolving credit, which is credit cards, home equity lines, things like that, is utilized. So it's going to look at what your limit is on the card and what your balance is relative to that limit. Now, the biggest hit is if you're over the limit. It's a huge hit to credit score. Never ever let your cards go over the credit limit. But really, to be safe, you shouldn't be over 50% of the credit limit on any of your cards.
Okay.
And now, the other thing to consider on that is also how many open credit lines you have. So you might have 5 or 6 department store credit cards, a Discover, an Amex, 2 or 3 Visas, and so on. And that actually also contributes to possibly harming your credit score by having too many open trade lines with balances.
Now, what I've found, and I usually tell the buyers, I say, listen, talk to your lender first before making the decision to close accounts. So would you say that it's important before closing accounts that it could also affect their credit score and
100%.
Not help them when they think, oh, well, I'm taking debt away from me, even though I'm not utilizing it, it can bring their credit score down?
Absolutely, and you're 100% right, Laura. And it's rare to see realtors that really know this end of the credit market, so I congratulate you for that. But if you pay off and close out a card, it's no longer factored into that utilization factor. So by closing out accounts, especially if those accounts have a long track record, several years of repayment history, you could actually be hurting your score. The best thing to do is make sure you talk to your lender that's pulled your credit. Most of us have the option to be able to see how to improve your score. There's a model that we can run through our credit vendors that lets us know what to pay down, how much to pay it down, how many points that will help improve your score. And that's a great tool. Don't just follow advice given to you by people that
Your friends,
aren't
your
in
family,
the know,
your
your friend,
parents,
your
yeah.
neighbor, your plumber.
Yeah, let me just tell you guys, if you're buying a house, don't ask your family whether or not you should buy the house. Keep it to yourself, and after you buy it, let everybody know you bought a house, because they're going to make you crazy.
That's true too.
Yeah. Okay, so we've talked about credit and what have you, and then we talked about, so that's a simulator, right? So what I typically tell people when they're working with me is I say, listen, let's talk to the lender. Let them have it. When they tell me, oh, my credit score is a 580, I'm like, okay, well, let's see. You might be able to go through a simulator to see that they can bring your score up to a 650. And 650 is good enough credit to buy FHA, correct? And sometimes other lenders, other programs. I think there's so many different programs with credit score, which we could talk about that as well.
That would be a whole nother section.
That's a whole nother section, and we might have time. But the other thing is that what I do talk about is I tell people, if their simulator isn't able to get you to a score of what you need, do you recommend, because I do, and I have somebody that I do recommend, and I'd love to have him come on the show, but I recommend somebody for credit repair.
Okay. Technically, due to Fannie Mae Freddie Mac rules, we can't as lenders recommend credit repair companies.
No, okay.
But you
That's
can.
That's interesting to know. I actually didn't know that,
And some investors won't buy a loan if it's obviously that the score has been rescored.
Okay.
So
I didn't know that.
And it's one of those, they don't want the factors being manipulated. They want to really kind of have this out and open and kind of clean, as opposed to being tailored and messed around with. But being very strategic in how you do this, there's nothing wrong with that. And being able to either spend some time with a credit repair company that knows what they're doing, okay? And that's, again, one of those things you got to do your research. There's a lot of companies out there that will charge you money.
They'll take your money and never do anything,
and you
never
get
hear from them
anything
again.
out of it.
Yeah.
There are certain things that they can do, and I've talked to attorneys that specialize in this, and there are a very defined process that they have to follow for certain things to get them off of the credit report.
Okay.
And that's where credit repair companies excel, is in getting things off completely. Things like collections, judgments, and things like that they can work on. Late payments, unless you can validate those late payments, we're not truly late, they're not going to come off. And
Okay.
credit repair company cannot fix that.
Okay. So one of the things that I think would be really important to talk about right now is what is going on with interest rates. Where is the economy going, and is this going to change? What's the forecast of this? So let's talk more about what is going on with these interest rates. Are they going to go up more? I mean, I've heard as high as 10%. Come January. I don't know you've been doing this for a really long time, probably before I was born. I'm just kidding.
Not too far off.
So what do you think? What do you forecast?
Well, and it's interesting you say that, because actually I got into this business in the early 80s when we were looking at super high interest rates. We had some of the same things going on then that we have now, super high inflation. Volcker came as Fed chairman and had to really clamp down to get interest rates in line. And that's what we're seeing now with Jerome Powell and the Federal Reserve. The problem we have is too much stimulus over too long of a period of time by the government, too much spending. A lot of it was brought on by COVID, some of it was by the financial crisis that happened before. But in order to keep the economy going, the government pumped a lot of money into spending, and too much so. So between that, the additional spending, supply chain issues and other costs of goods brought on by higher energy costs and things like that. So the Federal Reserve only has one way of managing the inflation rate, which is over 8% right now. Last time we had inflation over 8% was over 40 years ago. So the only way they can do that is to slow the economy down. To slow the economy down, the only tool they have is to raise rates. Now we're already seeing that it's having an impact. Pending home sales are down 5 months in a row now, which that might sound like really bad news, but it's not really bad news because it's working. So what we run into then is, as the cost of goods go up, as cost of mortgages and houses go up, less people buy, which that's exactly what the final goal is of the Federal Reserve, to slow down the economy, to get the inflation rates down. So will we see 10%? I don't know that we'll see 10%. I don't have a crystal ball.
Right.
Mine broke in 1999. We will see higher rates than we have today. We've gone from in the low 3s in January to over 7% today. Now, that being said, just it should be noted that the average rate for a 30-year fixed rate loan over the last 40 years is over 7%. The rates we saw in the last few years were artificially forced down by the Federal Reserve to try to keep the economy going. So are we going to see 2.5% and 3% rates again? Probably not. But are we going to see more nominal rates in the future? I would say probably. Most of the estimations I've heard, because the average recession is about 10 months, we're probably...
So that would bring us to mid-April, May?
Probably summer 2023, we'll start to see parity between inflation and interest rates. The rule of thumb is that the federal funds rate should be about where the inflation rate is. We're not there yet.
Okay.
Federal Reserve has said that they've already baked in a 3/4 point rate hike in November, possibly between a 1/2 and a 3/4 point in December. Now the good news is that we're starting to see some slower numbers in some of the economic factors that are pointers toward future inflation. So the Fed's thinking that there might be a pivot where they could start to slow down their rate hikes.
Okay.
So now it's important to note also that the Federal Reserve doesn't set mortgage rates. They set short-term interest rates. That affects credit cards, home equity lines of credit, car loans, things like that. Stuff does roll uphill because as shorter-term rates go up, longer-term rates tend to follow.
Okay.
So that's what impacts mortgage rates.
So if people are looking to refinance, and I would say right now, I guess one more quick question would be, is when somebody is looking to refinance, when does that make sense for them to refinance? Like, what is the rule of thumb?
That's a great question. So a refinance
I don't think now would be right now the time, unless you're at 15%.
So there's different reasons people refinance. Sometimes they refinance to lower their payment. Sometimes they, like in the last couple of years, when we saw rates in the low, upper 2s, low 3s, a lot of people refinance to lower their interest rate and to lower their monthly payment. That's not the case right now, of course. The other reasons people would refinance is possibly to do home improvements, to take money out to invest, possibly to purchase another property. Unfortunately, in the case of divorce, we see a lot of refinances where they're buying out the other party on a loan. So those cases, obviously, we're not going to see the first two options as very worthwhile because they're not going to reduce their payment. They're not going to reduce their rate from where they got a couple of years ago. But if they're in they need to do home improvements, or they're going through a personal family issue where they need to do something to be able to go forward with their lives, then it makes sense.
I could actually ask a ton more questions, but Mason, tell us where we can get you, what number would be best for people to call you if they had questions, how they would find you on the web, if you could let them know what would be the best number to get you at.
Well, thank you, Lauren. I appreciate that. So the easiest way to reach me is in our office in Boca, and the number there is 561-923-8482. Again, that's 561-923-8482. You can also go to prunermortgage.com. And I've got a longer one that goes for the mortgage firm website, but that's too long to tell you guys.
So if you need some mortgage help and you want to get in touch with Mason, you can always go to my website at www.laurasell. I couldn't afford the S. Anyway, it's www.laurasell, or you can call me directly at 954-650-0827. And again, we're here every Monday night at 6 o'clock here to talk about how we can make money. So we're here making money with Laura. I've been doing this for over 20 years. I am the #1 RE/MAX agent in the state of Florida for 2021. I am 121 in the United States according to the Real Trends in the New York Times. So I definitely have the information you're looking for. So reach out, give me a call at 954-650-0827. And I look forward to seeing everybody next Monday at 6 o'clock.
Money with Laura Sanders, a name you can trust. To join the conversation, call us at the studio, 888-994-4995 Studio A, or contact Laura directly at 954-650-0827. Laura Sanders, a name you can trust. We look forward to seeing you next week.